Good morning, Mr. President, Mr. President Mario Draghi, ladies and gentlemen. First of all, I apologize on behalf of Michel Barnier, who cannot be here this morning because this morning there is an important trilogue which he has to attend on the SSM, so the Single Supervisory Mechanism. And he had to make a difficult choice, and I became the victim being delegated for this mission here. I hope that I will be up to the job. It's a pleasure for me to be here, and I would like to thank Mario Draghi and the ECB for co-organizing today's event. It will give us an opportunity to exchange views and hear opinions from different sides, and I'm very interested to hear these views. Today's goal should be ambitious: to analyze all the current changes in the post-trade market. These changes, as we witness and participate in them, are significant. I would like to welcome, first of all, the participants and the panelists who will participate in our discussions here today. These discussions are precious, they are timely and important for us in the European Commission and for EU regulators at large. So, where are we? Many of the changes come from groundwork done over a number of years, starting well before the beginning of the crisis. And one man who was heavily involved in this is sitting in front of me, Alberto Giovannini. Looking back, it has been 13 years since the Lamfalussy report pointed to the importance of efficient pan-European clearing and settlement. It has been 11 years since the first Giovannini report identified technical, legal, and fiscal post-trade barriers for a single financial services market. And it is now 5 years since the financial crisis erupted and questioned our financial system as we knew it. It is this last event, the crisis, that has profoundly influenced the timing and objectives, of course, of all the financial reforms. Confidence of society in our financial system has been significantly rocked. Restoring trust is vital to encourage investment in Europe so that our economy can grow again. This is crucial to return to sustainable growth. Increasing the safety of the system, as President Draghi said, is a key goal to achieve this. In addition, the financial crisis made regulators realize that we can no longer afford inefficiency and fragmentation of the post-trading infrastructures. The need for a single market for financial services has never been so important as it is today. And better, more efficient post-trade services are important for the functioning of our markets. Before I come to the internal market, safety comes first. Safety is the basis for trust. The safety and resilience of financial markets is at the heart of all our work. This applies to regulating our banks, such as the new Basel III capital requirements, the banking union, as well as regulating financial markets more generally. And it is a simple truth that you can not have a safe and resilient financial market without safe and sound financial market infrastructures to trade, to clear, to settle activities. In our joint work with the Council and the Parliament, the Commission is addressing these safety issues at all levels. Take trading. Our new MiFID proposal will increase investor protection and market transparency. Multilateral trading will take place on multilateral and transparent trading venues, hugely important. All systematic bilateral trading will also take place in full transparency. Transparency will be the general rule for all orders and trades in all financial instruments. Looking at clearing, EMIR entered into force last August, and its technical standards prepared by ESMA, endorsed by the Commission, apply as from last Friday, the 15th of March. It reduces the risks of OTC derivatives that almost brought our financial system to its knees. It reduces credit and operation risks through mandatory clearing via CCPs. It brings transparency and sheds light on opaque deals, as all derivatives transactions will have to be reported to trade repositories, and that will start in July. Data will be accessible to supervisors, at last. We didn't have them in the past. This should prevent a domino situation in the future where a collapse of one financial firm can trigger the collapse of other firms and the system as a whole. Take settlement. Central Securities Depositories, CSDs, are the gatekeepers of collateral in the system. Like CCPs, they are systemically hugely important. Building on G10 CPSS IOSCO standards and ESCB CESA guidelines, the Commission's CSD proposal provides for prudential and operational requirements for CSDs and introduces more competition between CSDs, which today are still, in a number of member states, monopolies. So much for safety. Have we forgotten about the single market? Of course not. I can assure you that this is in the heart of all our reflections before we make any proposals for the legislature. In fact, safety and efficiency being linked to internal market, are closely interlinked. They are combined across our proposals and cover the life cycle of a financial instrument. For trading, for instance, our new MiFID proposal strengthens the single market in financial investment services that was already introduced in MiFID I. It contains now key proposals to ensure fair and non-discriminatory access to CCPs and trade platforms, which is essential to enhance competition and deepen the single market in financial services. We should not forget in all our financial reform work about the importance of competition. We do build into our proposals always this consideration. So you may get the impression that we're only focusing on financial safety, but we combine that always with the objective of competition, and hence our provisions in MiFID. At the clearing level, EMIR has access rights for CCPs to execution venues. This is balanced, of course, by a need for regulatory approval for interoperability between CCPs and safety concerns. We are very conscious of that aspect. For settlement, the Commission's CSD proposal will create a single market for securities settlements by harmonizing standards, settlement cycles, and settlement discipline. It paves the way for a new era. Today's domestic CSD monopolies will have to compete with competitors from other countries. Firms that issue financial instruments will be able to do so in any CSD in Europe. They can choose their CSD. There will be open access by users to CSDs and between CSDs and other market infrastructures. So again, very important from a competition point of view. Parallel to the CSD proposal, the ECB's important efforts relating to the T2S project will significantly change the European settlement landscape. Cross-border security settlement services will be done on a single platform. CSDR and T2S go together, hand in hand, and aim for more efficient and cheaper security settlements in the EU. That is the objective. Future. This, what we have already done, is not the end of the road. Our common journey to ensure safety and internal market has to continue. Securities law legislation. We are looking at a proposal which should increase the certainty of securities holding and dispositions. I know that the ECB is a long-standing supporter and advocate for measures in this area, because the ECB has to work with collateral every day. Answering the question of who owns what is crucial for investors and issuers, for regulators and central banks. It will support the management of collateral in mitigating systemic risk. And of course, our work on the resolution and recovery of CCPs and CSDs. We are looking at supplementing the Commission proposal for banks with a proposal on CCPs in the first place. We concluded a public consultation in autumn. The Financial Stability Board and the international standard setters CPSS IOSCO are also, of course, working on this important issue. We must ensure that the failure of financial market infrastructures, particularly CCPs, can be managed through orderly recovery and resolution arrangements and protect financial stability and taxpayers. Of course, we should make sure that this never happens. Particularly with CCPs, we should make sure that everything is put in place, that we will never come to the point where we have to resolve a CCP. This brings me to timing. In these times, our regulatory response on financial market infrastructures must be targeted and go in parallel with all other regulatory reforms. It must be coherent and consistent. The regulatory shift in gear for post-trade harmonization complements other reforms to restore safety, stability in our markets, such as the work on the banking union and CRD4. Timing is also, of course, of utmost importance for our work on T2S and the CSDR. T2S should be launched in mid-2015. Several aspects of T2S are directly covered by the CSD proposal. They are complementary. It is important that the Council and the Parliament adopt the CSD regulation quickly. Its technical standards need to be in place and enforceable, preferably before the CSD is launched in mid-2015. The Commissioner welcomes the European Parliament's commitment of last month. It has adopted its report, prepared by Mrs. Swinburne, and is keen to start discussions with the Council. We now need rapidly a common position in the Council so that the institutions can start to work together to reach agreement in the course of this year. Time is also becoming an issue for MiFID. The European Parliament adopted its position already last October. We are counting on the Council to agree on a general approach soon so that discussions with the Parliament can commence. We need to make progress so as to deliver on our G20 commitments, also on trading, introducing in particular mandatory trading for standardized derivatives. We don't want to lag behind. We are very much, in terms of substance, online with everything which is being done on the US side, but we have here to push on the accelerator again. We are responding to the global regulatory reform and standards set by G20, the Basel Committee, CPS, IOSCO. The timely adoption of EU initiatives matters for our credibility in the global market. Europe has to be seen as a credible counterparty in our dialogues with regulators for abroad. We have to be credible with the markets. We have to be credible also internationally. We are making headway and setting good examples. EMIR's technical implementing standards entered into force, as I said, last week. We have nearly reached agreement on CRD4 to implement Basel III, and we are committed to keeping on all fronts our foot on the accelerator and to keep momentum in this work. Let me say a word on international. Time is one aspect. It is equally important that our rules can work in a global context. We invest huge efforts, together with ESMA and EBA and EIOPA, of course, in making sure that our financial regulation can work and interact with other jurisdictions. Let me mention our dialogue with the US about EMIR and Dodd-Frank Act as an example. These are difficult discussions, but they are necessary and take time, and as all discussions between good partners, they require a lot of effort. Our objective is to ensure that there are no loopholes or gaps. On the one hand, we are not in for creating regulatory arbitrage between jurisdictions, and our objective is to facilitate the clearing and execution of cross-border derivatives by relying on each other's rules to the extent possible. A global market cannot function with multiple inconsistent and overlapping rules. We have a duty, after having imposed mandatory clearing on industry, for good reasons, to ensure that companies can work with one set of rules. Each time the rules of different jurisdictions can be considered to be comparable. That is an important consideration for the efficiency of the functioning of global markets. Allow me finally to address an important phenomenon that is closely related to the new regulatory framework across, and that is collateral. With the crisis and with a number of new regulatory requirements, such as the margining for clearing, the liquidity requirements of Basel III, two examples, there is, of course, an increased need for more and better quality collateral, as President Draghi just said. There's a growing consensus that there is probably enough potential assets that could act as collateral to meet this demand. However, there is also potential for a collateral scarcity to develop. Scarcity is beginning to change market practices. As identified by the FSB, these practices have the potential to create hidden leverage, increased interconnectedness, and disguise where the risk really lies in the system. Some collateral management challenges posed by fragmentation are best addressed by market-driven improvements. Better collateral management will also require improved systems that will allow institutions to accurately see where their assets are. This will require improvements to book entry systems in holding chains. Meanwhile, innovative services have started to appear already to resolve fragmentation within and between markets. There are some players who start really seizing new opportunities. Access to the right collateral could be improved by solutions, for instance, like Clearstream's Hub or Euroclear's Highway. But it will be imperative that collateral can circulate between the systems and around the single market. Some of the fragmentation in the markets cannot be overcome by the market participants. Reforms such as EMIR, MIFIR, CSDR, and our planned securities law legislation should help to address this while also helping regulators to better understand evolving developments coming from international reform. The better regulators can understand the markets, the more considered potential regulatory responses can, of course, be. This will require significant improvements to the transparency of markets. Post-trade harmonization has a key role to play in enabling this transparency. We are working with the ECB and European regulators as part of the FSB's shadow banking workstream to develop solutions in that area. Summing up, the new regulatory framework for financial market infrastructures addresses many single market barriers in the post-trade sector. It contributes significantly to the new landscape where trading, settlement, and clearing services in Europe should be provided in a non-discriminatory, open, and efficient way. We believe that it will increase healthy competition. At the same time, and responding to the crisis, the new framework will ensure safe and should ensure safe and resilient financial market infrastructures. They are the bedrock of our stable financial system. The challenges we face are challenges for all of us. As President Draghi said, we all need to be participating in the action. Global and European regulators, legislators, and industry. Don't wait only for the regulators and the legislators. This is work for all of us. It is a continuing journey to deliver post-trade harmonization and financial integration in Europe. Thank you for your attention.